I likely don't have to tell you that prices have been rising. Everything from groceries to fuel to lumber have spiked massively and gone through a lot of volatility over the past few years. This comes as inflation has reached its highest level in 40 years. And that's if you go by the official metric. Now, while this has sparked a fierce debate about whether or not this is transitory inflation or more persistent inflation, it has fostered a lot of discussion over what exactly the best inflation hedge would be. An inflation hedge is any asset that can maintain its purchasing power or value, or increase its purchasing power and value, over time in the face of extreme inflation. These are ideal assets to hold when money is being devalued. Now, theoretically, inflation hedges should be fairly common, because as money is being devalued, everything denominated in that currency should be rising proportionally. But it doesn't work like that. Assets are affected differently. Take stocks, for example. At first, one might think stocks are a great inflation hedge because companies have pricing power over their own products, and they can more effectively weather the storm. But it's definitely more complicated than that. As interest rates rise to compensate for the devaluation of debt, it becomes harder for companies to finance new projects and developments, and it's harder for new companies to get funding, especially when you're in an environment like you've been in for the past 10 years, where a lot of the increases in equities have come from stock buybacks financed by debt. That can be a very difficult proposition to say that stocks will increase in the face of higher interest rates. And while we've yet to see the effect of rising interest rates on the current market, although, it seems like it might be taking a bit of a hit, we have seen this sort of situation before in the 1970s. As you can see from this chart of real equities values in that decade, when we were experiencing high inflation, the inflation-adjusted value of stocks declined. This is not only because of difficulties in financing, but also just because of the difficulty in controlling the costs of production, which put a big hamper on profits. So what about more traditional assets like gold? Well, in the wake of the Great Recession, a lot of people were pushing gold as an obvious inflation hedge, and surely that mentality has continued into the present day. But now that we've seen nearly 10% inflation, can we say that gold is a good inflation hedge? By all objective metrics, I'd say probably not. Gold peaked in 2020 when inflation was still low, and as inflation rose, gold actually declined. And that's only in nominal terms. If you adjust the price of gold for the concurrent inflation, it had a much steeper decline, hardly an inflation hedge. And this is because of one of the most complicated nuances of finding a good inflation hedge. The best inflation hedges are not typically seen as inflation hedges. The reason for this is because if something is seen as protecting against inflation, then in the eyes of investors, automatically the price of the asset is more dictated by the speculation around future inflation, not current inflation. So gold rose in 2020 as a response to massive money printing during the pandemic because some investors anticipated inflation. A similar situation could be seen with Bitcoin and other cryptocurrencies, which were posited as an alternative to gold. They peaked when inflation was low and then declined thereafter, although there's a bit more volatility there. And granted, there's a lot more going on with Bitcoin, which we won't get into. So what is a good inflation hedge? Well, I'd argue that one of the best inflation hedges is actually forest land. The reason why is because timberland in itself is a highly diversified asset capable of a lot of different types of production. Thus, with it, you can get exposure to a lot of different types of asset classes and types of inflation control. So let's start off by looking at it from the real estate perspective. As we've seen after 2020, real estate inflated massively. Whatever the causes, be they low interest rates or stimulus money or what have you, there was a large buying spree after the pandemic, and we saw real estate explode in prices across the country. Timberland was no exception from this. Of course, the effect of inflation on real estate was, well, asset inflation. There was another effect that wasn't seen as broadly. Most people's mortgages they had on those properties actually carried a negative interest rate. I had my mortgage locked in at 4% and inflation reached almost 10%. So the real interest rate on the mortgage was actually negative 6%. So every year, inflation wiped out 6% of that mortgage. And while the concept of a negative interest rate might be a little more abstract, let me put it like this. When I bought my house, I couldn't have afforded it on a McDonald's salary. After the pandemic, I could have afforded my house on a McDonald's salary because the mortgage payment stayed the same, while wages for fast food workers, for example, increased massively, almost 100% increase in some cases. So while real estate can theoretically work as a good inflation hedge, it does come with certain risks and drawbacks. For example, especially if you have debt on a property, that debt can really hamper you financially in the event of an economic downturn. And speaking specifically to timberland, sometimes it can be hard to get financing for just raw land. Additionally, real estate can be fairly illiquid, which means it's hard to sell. And of course, there's always the brokerage fee for selling it, which for land can be as high as 10%. But timberland has the ability to be liquidated fairly quickly in the form of a timber harvest. That brings us to our next point, stumpage in the price of timber. So the second benefit of forest land is that it actually acts as a sort of asset for industrial production of commodities, which in this case will be lumber. And while lumber on the commodities market is specific to softwood dimensional lumber, random length, there's a whole broad swath of products that it can create. And many of these products over the past 2 years have seen massive increase in prices, lumber being the most obvious. And stumpage, which is the price landowners receive for timber harvest, tended to reflect these increases in value. Here you can see a chart of log prices in Kentucky between 2020 and 2021, and you can see across the board in species, we saw 20 to 30% increases. Unfortunately, this increase in prices came at another cost, which is the cost of production itself rose. For example, as of recording this, diesel fuel is still hovering around all-time highs, although it is down a little bit from the peak. And diesel's incredibly important for all aspects of timber harvesting, from the actual harvest itself all the way to transport. So the landowners that actually saw the best benefit of their timberland as an inflation hedge were those that had their own forms of cost control. For example, those that could cut out transportation of the roundwood entirely. I know several people that have sawmills on their property and harvest the logs and bring it directly to their sawmill, so they don't even have to put the roundwood on a truck, which cuts out a huge chunk of that process. If that small sawmill could then avoid going to Home Depot or something, which had to pay higher prices for wages because of a labor shortage, they cut out another part of that process. So the landowner that was able to produce their own lumber and then cut out the middleman and disintermediate in all those different ways, thus avoid the increase in costs in those facilities, was able to see massive gains. And that's a really important aspect of an inflation hedge to remember, the benefits of cost control. This is true whether or not you're investing in forest land properties or you're investing in an individual equity. Something is going to be able to weather inflation better if they have more control over costs. And that brings us to our last point. Timberland itself is actually part of the energy market in a sense, and if you own some, you can create cost control for yourself from energy markets. Of course, I'm speaking about firewood. Having the ability to harvest and cut your own firewood and heat your home through the winter without worrying about how high oil is going is a huge benefit. While at first that might seem a little bit silly because of all the work involved in harvesting one's own firewood, consider the situation in Europe right now. Google searches in Germany for firewood have actually exploded since the prospects of massive shortages this coming winter. Owning property on which to harvest firewood essentially makes you your own individual energy producer, which can give you massive protection from massive increases in prices. Perhaps this is best seen in the more cataclysmic scenarios, but nonetheless it's an important one. So between those three aspects of timberland properties, it offers a great deal of optionality. It has the ability to offer at least some protection in a variety of situations, anywhere from moderate to high inflation to absolute societal cataclysm. So what do you guys think? Is forest land a good inflation hedge, or am I out of my mind? Let me know in the comments. And if you like this, like and subscribe for more. Until next time, later.